Share prices in Shanghai have lost a third of their value since mid-June. But what's happening in China is not being called a Lehman moment. For more insight, we're joined by Simon Mall. He's the head of Asian equities at Auerbach Grayson, a New York-based brokerage firm. Thank you so much for being with us. Let's talk about the potential for ripple. I know that people are looking at this and wondering, is this going to hurt confidence? Is this going to deliver a blow to the Chinese economy, one that many worry is already slowing? How serious is this?
Well, I'm not going to sit here and tell you there's going to be no impact. I mean, clearly there's going to be an impact on sentiment and confidence. I do, however, want to put it into context. Stock market investment in China is not still a widespread phenomenon. I think only about 7% of the Chinese population have stock trading accounts. If you look at where people's wealth is tied up, it's in property. About 75% of household wealth is in property. What you don't have in China is an equity-based retirement savings system. There's no 401k equivalent. So what that's leading towards is, my feeling that we're not going to see a huge negative wealth effect on the broader economy of this market correction. We didn't see it on the way up. I mean, don't forget that the market is still up 70% year on year. At its peak, it was up about 150%. If you look at the retail sales numbers, they've been slowing the whole time in China for several years now. And the most recent data we had, I think, showed retail sales up 10% year on year. So no, I would not expect to see a widespread negative wealth effect to hurt the Chinese economy outside perhaps a few very high-end luxury consumption kind of companies.
And that is very important context because that's what global investors are watching. The other thing I'm hearing a lot, Simon, is concern that somehow this might damage politically. There might be political damage or fallout. Everyone thought that the Chinese government was in complete control of every aspect of their economy, and it turns out they don't seem to be able to stem this. What about that political fallout?
Again, I would suspect the political fallout is going to be limited. China's liberalization of their economy is not really what's to blame for the market rally or the market collapse. It's been a pure case of greed and fear, as I believe Ivan mentioned before. This has been a speculative run, and now it's fear on the way down. There has been no support from fundamentals. China's economic liberalization has been based on improving China's standing in the global economy through opening up markets. It's been focused on banking deregulation to improve the allocation of capital. Those are admirable goals. They're long-term goals. And they are not goals that I think are going to be derailed by a bubble and a collapse of a stock market. Now, I would put one caveat there. I would say if the social unrest that could potentially emerge from a massive stock market collapse were to become so serious as to threaten political stability, then I think you might see a change of course. But I think that's a very, very unlikely scenario.
And we're almost out of time. So, Simon, one last question. We have started to see this spill over to Hong Kong. We see Australia down. This is always a confidence game. These statistics may all be true, but if global investors, it's a nervous time for markets. Do we need to watch for that? Do you think that will continue? And would that be a game changer?
Yeah, I mean, absolutely. There's nervousness, but I think what we need to look at as a flaw to all these markets is valuations. The valuations of the Hong Kong market have never been stretched. If you look at the valuations of A shares, that's the domestic Chinese shares, against H shares, which are those listed in Hong Kong, they're still trading at a 50% premium. Actually, that premium has widened. I think you're going to start to see value appearing in Hong Kong shares. I think if there is a sentiment-driven sell-off around the rest of Asia, again, you will see value appearing. Those other markets which are dominated by international institutional investors, are markets that trade on fundamentals. And if they sell off, people will start looking for value. It's simply not the case in China. The fundamentals have been never been there to support the market on the way up or on the way down.
Excellent, excellent point. Simon Mall from Auerbach Grayson, thank you so much for joining us and helping us understand this.
You're welcome. Thank you.